The world is changing to a net zero carbon world. A lot of investment is happening into this direction, and I think the speed of this investment will go up. What does this mean for the world? What do we need to supply this trend? I think minings and minerals are an interesting topic in this case. So I've invited another expert to discuss this topic for you and also to give ideas how to navigate this topic as an investor. Enjoy the conversation. A warm welcome to the Good Investing Talks podcast. I'm your host Tilman Fersch, and I'm very happy that you're discovering underfollowed investors and underfollowed companies together with me. Before we jump into this conversation, I want to thank my supporters. They help me to keep this channel free and public for everyone. Thank you very much. If you also want to join the Good Investing Supporters Club, please click on the link below. You're very welcome. And now, one last step. Here's the disclaimer for you. All we are doing here is no advice and no recommendation. Please always do your own work. And now, enjoy the video. Dear viewers of Good Investing Talks, it's great to have you back at the show. And today I'm having Anthony Young with me. He's LA based. And today we are also discussing a topic that I've already discussed with him in pre-chat, so I assume it's the impact of the energy transition and the impact of the energy transition on minerals. But first of all, Anthony, how are you doing?
Doing well. Thank you for having me.
I think it's the first time you're on a podcast, so I hope you're not too nervous.
It is my first time, so I'm excited.
I'm also very excited. Before we started this conversation, we already chatted a bit about the impacts of the energy transition, especially on metals and mining. And with metals and mining, it's always a lot of digging you have to do. Yeah. But before we dig into this topic, maybe let's add a bit of background information. So what did you do before you started to become a full-time investor?
Yeah, absolutely. Maybe just, before I start, my compliance department always asks me to give some standard disclaimers. So I'm here representing my own thoughts and opinions. And I know, Tillman, you have a very robust disclaimer, but again, this just shouldn't be viewed as investment advice. And as far as my background goes, I started off as an engineer. So an electrical engineer, was working in the aerospace industry in the 90s. Got both my undergrad and master's degrees in electrical engineering before I decided I didn't want to be an engineer anymore. So I went back to business school at the University of Texas, where I got my MBA focused in finance. Really kicked off my Wall Street career at Bear Stearns, where I was in the metals and mining team. And that was really my first introduction to metals and mining in what many call the super cycle of that 2004 to 2012 timeframe. So worked at a number of different investment banks, worked at a couple of different hedge funds before starting my own fund in 2017. Again, just focused on the energy transition.
It's a very interesting journey you've done as an investor. So what took you from the metals and mining space to look into the energy transition and renewables?
Well, truth be told, when I initially started, I was looking at coal. And, you learn a lot being a coal analyst. You learn a lot about the grid. You learn a lot about utilities. And then as you begin to think further about, how these things are going to play out, because even in the 2000s, the early 2000s, you could see the sentiment rising against coal. And just beginning to think about, as people were looking for cleaner forms of energy, what would be next? And it's not to say that when I started in metals and mining, I knew that copper and aluminum and nickel were going to be so important for the way that the world was going. But as you dug in over the years and you begin to realize the intensity of those materials and renewable forms of energy, that's what sort of led me to this theme that we're pursuing with my current job situation.
What might other investors that don't look every day into the energy transition be missing in this field?
That's a good question. I think that metals and mining are just historically have been viewed as very dirty undertakings, but still very important when you think about electrification. So I think looking beyond just the fact that dirt is being moved and deposits are being exploited, I think on some level you have to look about the longer term benefits, and sure that there are consequences of the mining process, but because of those consequences, you have or you can the world can generate cleaner forms of energy for longer periods of time. I think, which somewhat offset what's being done at the moment.
So if we think about the current grid, it's highly based on hydrocarbons, oil, gas, and coal, for instance. So if you think about decarbonizing this, what does this mean for investors? Like, what is the impact of a decarbonization of the grid, and especially not only the grid but also heating and all the other stuff that has to be decarbonized too?
Yeah, I think so. I think it's a bit of a moving target because there will be government incentives and capital markets coming into play, but a leading Wall Street bank has sort of indicated that the United States will require about 25 trillion. That's with the T, $25 trillion over between now and 2050 to switch to a carbon neutral grid, if you will. And then Europe will require about $30 trillion to revamp. And I think Europe, just given some of the things that have occurred over the last year or so, requires slightly more, about 20% more than the United States. But I mean, those are the numbers that we're sort of talking about, and obviously that's before China, Japan, and other emerging markets. So, I mean, I think globally you could see that number swell to probably over 100 trillion if we're really going to go towards that net zero by 2050, which 25, 27 years away. It's not that far away.
To think about 2050 is very important if you think about the energy transition and all the decarbonization issues. So if you want to go down to net zero to 2050, it's like only 26, 27 years. So it's a quite short time period. And what does this then mean for like the whole infrastructure providers that have to deliver all the stuff for the energy transition, like cables and wires and copper? For instance, like, do we really have the capacity for this? And does this also impact like the way the business is done? Because if you think about like a shortage in capacity, it's not really a commodity business anymore. It's highly dependent on like, yeah, the cycles, but you have this clear path to 2050, and if you optimize for it, it's not enough time to build up that much capacity and rebuild everything. So what do you think about the commodity business argument and this short time period?
Yeah, I think with respect to the commodity business, it's been dramatically underinvested in if you believe we're going to meet these goals by 2050. I think even just globally, we've probably been underinvested in if we're just going to have a standard GDP growth of 2 to 4%, on an annual basis. Even in that scenario, we've been underinvested in. But if you think that we're going to completely revamp the grid and we're going to put on a tremendous amount of renewable energies, um, those renewable sources of energies, on the copper side of things, which is where I spent a lot of my time thinking about. When you're talking about wind and solar, it's 4 to 5 times as copper intensive for a megawatt, and that's onshore. If you're offshore, it's even more intensive than that. But again, these are intermittent forms of power. So then, when you think about how you translate that into a constant source of power, it's probably somewhere between 10 to 15 times as copper intensive for those renewables to have a baseload source of power, which would be wind and solar with a battery backup. So, under those scenarios, and a major copper company reported this morning, and they indicated that they think that the world will need twice as much copper by 2035 as we currently produce today. I've been in the industry since 2005, and during that time, with tremendous amounts of capital spent during the super cycle, copper production is probably only up about 40%, 35 to 40%. So for it to double in the next 12 years, and then probably another 20 to 30% in that 2050 range, um, there hasn't been enough investment, and it will likely require higher prices to incentivize that investment.
We will jump into the copper topic later in this conversation, but maybe let's look at the bigger picture and think about infrastructures a bit more. So I'm in Stuttgart here, and usually I say there's Daimler and there's Porsche this direction, and I live in between. But today I want to say that there's also a power plant and there's a power plant, and the power plants are directly in the city. They burn fossil fuels and like coal or gas. Or even waste at this power plant here. And they produce energy in close proximity to the cities and the demand. But if you think about renewables instead of fossil fuels, like wind is somewhere out there in the countryside. There's also solar, has also a bit of a lower energy density and has to be installed in many houses. So there's a lot of surface it has to cover. What does this change in the structure and in the grid mean for investments and also for the infrastructure we have to remodel?
Yeah, I think taking things further out, and to your point, it comes down to energy density, and the density of wind and solar isn't as great as that of natural gas or nuclear. And again, taking things further away just requires more raw materials. So not only that, but also they just have such larger footprints than oil, or excuse me, not oil, but natural gas and coal-fired facilities, until that has a cost in and of itself. I think environmentally, whether it be with animals or birds, or obviously insects are impacted as well. So I think those are things that to take into consideration when.
I think cats are more dangerous to most birds, I think, but please continue.
That's absolutely fair. Cats are killing machines, if you will. But I think just taking into consideration when you're building a model on a wind farm or a solar farm, the amount of real estate I think is just taken for granted, and sometimes, but that can't be ignored either when you're running these numbers.
It's time for a quick advertisement. Here we go. Are you looking for a beautiful and efficient way to analyze stocks? Then please check out what my friends at Stratosphere are building. They have built a great tool to visualize data, to get ideas about ownership of stocks, and many more information that's helpful in your analysis process. You can find the tool via the link below, and feel free to sign up. It's free. Thank you for your attention. And now, Edward Tillman, Ende. There's also an interesting Bill Gates video I've watched recently. It's on the amount of grid that has to be built out to be suitable for renewables. I think it's twice the amount of grid that we already have that has to be built out to decarbonize and switch to renewables. But another interesting point I wanted to ask you about is the volatility of renewables. So if you think about wind and solar, you sometimes have peaks with a lot of energy that is supplied. So you have quite unstable supply to a certain extent. but on the demand is quite stable. Um, what does this kind of like mismatch maybe mean?
Right. I mean, I think that when you have the transition to wind and solar, I think for a long time, utilities um, were able to generate power and they understood what that power profile was like. You understood that if you were turning up a natural gas fired facility or a coal facility, it would operate at a certain level for a certain amount of time until you took it down. And then you had to respond to the demand side of things, right? So you have hot days, you have cold days, um, and you have obviously peak times, 4 to 9 o'clock in the evening. So the demand side was moving around, but you had a supply side that was very stable. And now you have a supply side that moves around and you have a demand side that moves around as well. It makes it very difficult to um, plan, makes it very difficult to plan. I think that's why you've seen some of the situations that you've seen in Texas here in the US in particular, in California during, particularly during the summer, where you've had blackouts and brownouts because wind and solar, the wind blows and the sun shines when it does, but that the demand side of things you can't control. And if you can't control the supply, but your demand is very constant, then it makes it difficult for utilities um, without just pursuing extreme robustness in ways that they haven't had to in the past. And that means substantially overbuilding relative to what you may have done in the past.
Yeah, let's jump back to the material demand, like in materials that you need for the energy transition. What kind of demand for copper, all other minerals are we talking about in this case?
I mean, it runs the gamut, right? Like I said, I spend a lot of time on copper, but then obviously everyone likes to talk about the rare earths and uranium. They play very important roles in the energy transition. Uranium, obviously, for nuclear, rare earths, um, principally in windmills, but there are other applications that are being developed, and they're used extensively in electric motors as well, in addition to windmills. But there's other cutting edge things that are being developed. But then I think that there's also the second tier of metals, things like vanadium, thorium, tin is a very important metal in electrification. So I think that there's we only have one periodic table, um, obviously, and there's the metals on there play different roles, and I think historically, um, copper and aluminum were the two biggest, most important base metals. Nickel to a lesser extent. But as we go into this energy transition, you're going to see the next level of metals become more important, which, in their own regard, have been underinvested in, because, frankly, they haven't been as important in the past as they will be in the future.
Aside from copper, which we are talking about in a few minutes, what kind of metals are interesting for you? For instance, if you couldn't invest in copper, what kind of metals would you invest into?
I like nickel as a metal. I think that is important in a number of different regards. It's in some manufacturers, that nickel cobalt manganese battery is the dominant um, battery chemistry. You've had some transition away to lithium iron phosphate, which doesn't use any nickel, doesn't use any cobalt. But I think nickel still remains extremely important for folks like Volkswagen and um, BMW, Ford, and GM. Tesla has moved away from it on some level. So I think nickel is very important. Obviously, lithium is very interesting. I think that every battery chemistry uses lithium. I mean, there's talk of sodium becoming more important, but I think that that is a much longer time frame. I don't think that we'll see sodium batteries before the 2030s in scale. I mean, you may see some one-off projects here and there over the next 5 years. Um, then outside of that, I think that again, tin is a metal that's used in solder. So when you're tying electronics together, solder is the glue that holds things together. And tin is a metal that um, long forgotten about. There was a tin crisis in the 1980s, um, which was driven by governments dispersing their tin inventories. Um, put a lot of it took a lot of folks out of the market. But now, as you think about, and people like to talk about semiconductors a lot as being sort of the building blocks. But every time you have a semiconductor, you have tin somewhere in that equation as well.
Are there any books you could recommend when you want to dive deeper into the world of metals and mining?
So, I mean, there's nothing really comprehensive. I think a interesting book that's timely right now is a book called The World for Sale. It's by Javier Billis. He's a Bloomberg writer and really just gets into the metals trading and how it goes from the mine to the finished product and the traders in between. I think an interesting book just on the fundamental mining side. Very old book. It's somewhat hard to find now. It's called Grasberg, and it's about Freeport's mine in Indonesia, and just goes through how difficult it is to build or to develop and build a mine. So the Grasberg, which now is either the world's second or third largest copper mine, depending on where they are in their ore grades, and the world's first or second largest gold mine, was discovered in the 1920s. But it took them 70 years, 70 years to develop. Um, and when you think about the profitability and the cash flows that are possible from having a mine of that size and scope, you think you find it and you develop it right away. But just given work, the work you have to do with governments and the infrastructure that needs to go into place and the permitting and raising the capital, because that's the thing. When you find a mine now, you're typically not finding a mine, you know, 50 or 60 miles outside of some major center. Now you're finding mines in very far flung places, which require working with indigenous people, getting permits, convincing someone to give you financing. And that time frame is just extremely long.
Welcome to the copper topic. Maybe let's start talking about copper intensity. So, for instance, you have this gas plant over here, you're replacing with windmills and solar. What does this mean for the copper intensity? So, what kind of copper intensity talking for instance, for this gas plant or the general replacement of plants with renewables and wind? What does this mean for the copper intensity?
Right. I think that when you think about the copper intensity, it's twofold. It's the fact that when you're tying windmills and solar farms together to bring that copper into the city, just the additional wiring and cable, it's about 4 to 5 times as copper intensive for wind or solar. I think solar is slightly more copper intensive, but still, maybe solar is like 5.5, maybe copper's 4.5, say 4 to 5 times as intensive for each megawatt that you bring on. And then, given their intermittent natures, um, they're when you're talking about natural gas fired or say nuclear, Nuclear runs about 0.9% of the time, so 90% of the time it's up. For wind, that's about 0.25. Maybe if you're in a windy place, maybe 0.3. And for solar, it's about 0.2, 0.25, something of that nature. So you need 4 to 5 times as much of those generating operations to um, mimic a conventional power source or a carbon-based power source. So when you take into consideration, it's 4 times as much for just the additional cable and wiring, and then you need 4 times as many, or you need 4 times the build to get to the same reliability. You very quickly get 10 to 15 times as much copper intensity for every megawatt to have that sort of baseload power as you would with a nuclear or a coal baseload power system. So, I think we're already seeing it in some countries where typically when you're industrializing, you become more and more copper intensive as you build out just the things that make your society work. But then once you get to a certain per capita GDP, that copper intensity flattens out. What we're seeing now in some developed countries, particularly in Europe, is we're starting to see the copper intensity of those societies start to tick up again um, as they install more wind and solar, just given the copper intensity of those applications in their grid. And I think that, and I built supply demand models for the better part of 10 years. I would never imagine that a country, once they've reached that certain level of industrialization, that you would see an uptick in their demand because, why would you build out more infrastructure? But that infrastructure really is, the green energy applications, which I think it surprised a lot of folks uh, on the demand side of things over the next 10 to 15 years.
Now let's go away a bit from the wind and solar side, like the energy production, but also like on the decarbonization side. What does decarbonization mean in housing and cars and all the other spaces we have to decarbonize for the copper intensity? So how does the copper intensity change in houses with the cars? Do you have some numbers there?
Yeah, cars, they're about 4 times as copper intensive or excuse me, electric vehicles are 4 times as copper intensive as internal combustion engines. So an internal combustion engine will use about 50 pounds of copper. If you're talking about, um, compact SUV, bigger SUVs will use more. Bigger trucks will use more. Smaller cars will use less. But if you have that same sort of compact SUV, I guess, on the electric vehicle side of things, it'll probably use about 200 pounds of copper. That's a big number. And I know that the OEMs are focused on bringing that down, and maybe they bring that down to 3 times um, on the as copper intensive, but you're still talking about triple the amount. And transportation accounts for about 25% of copper demand. So, if you're tripling the amount of copper that goes into electric vehicles over time, and as sales move in that direction, it's going to have an impact on the demand equation pretty quickly.
And what about houses and heating?
And houses is difficult, right? I was looking here recently, and um, the average home in the United States is about 45 years old, and the median home is about 35 years old. And when you think back to 1978 or 1988, no one could have envisioned homes that had two electric vehicles, that had um, you know, on some level, you can envision air conditioning systems and what have you. But running all of these things at the same time, two electric vehicles, air conditioning, heater, hot water heater, all being electrified at this point, you're going to need a retrofit of many homes, particularly the ones that are on the other side, on the left hand side of that bell curve of 35 years on the median, excuse me, on the right hand side of the bell curve of the median, because again, bringing that amount of power into your home just was never envisioned. So I mean, those numbers are a little bit murkier, but I recall that there was something on the order of 500 pounds of copper in your average home, and a large part of that is going to be in the pipes, but a portion of that is certainly in the wiring, and that wiring is going to need to be augmented um, in order to be able to service the demand that's going to come from electric vehicles. Obviously, if people go from, you know, natural gas furnaces have already been outlawed here in California starting in 2030. If you're going to go to heat pumps instead of natural gas fired heating, just the power requirement will be substantial.
Yeah, you have to do a lot of retrofitting, and
Exactly. Exactly.
there's also one thing I find interesting as a European when I compare Europe to the US. That's the density of the infrastructure. Like in the US, you have very long roads or roads and very long distances. You have to retrofit and put cables and other infrastructure in the ground if you want to decarbonize it. And like in Europe, it's denser. Like this lack of density is also a bit of a challenge.
Yeah, I mean it's interesting, right? And it gets into a couple of other different things, because on the electricity side of things, the overhead wires that you see um, are aluminum for the most part, with uh, insulation around them. But then as you get into the stations that breaks up those high power lines into um, lower power voltages that can be used, in neighborhoods and what have you, that's when you go back to copper. So, the long power lines, um, it's aluminum, and aluminum has its own supply demand challenges, but just you will have more of a requirement for the substations and areas that break down that power into lower voltages, and that will be copper intensive as well.
Hey, Tinlan here. It's great that you have made it that far into the video, and I think it shows a certain passion for investing you're having. If you want to dive deeper and go further down the rabbit hole, you're invited to apply to my community, Good Investing Plus. It's a place that's very helpful to people who are ambitious about investing. It's helpful to investment talent as well as experienced fund managers. So if you're interested, please click on the link below. And now, without further ado, enjoy the conversation. Yeah, we are now at the point where we could say like there's enough growth in the demand for copper. But what does this mean for the supply side? Is there enough supply that's coming online in next years, or is there enough?
The supply side of the equation is extremely challenged. I think that, um, again, on the investment side of things, that there's two sides of investment into mining. There is the investment into building out mines, but then there's also the investment that goes into exploration. And I think exploration has been out of favor for a long time, right? So I think, if you go back in time, um, 60s and 70s, being an exploration geologist was a career that was pretty interesting and in vogue, if you will. Now, many universities have canceled their, um, canceled those programs that would feed into those types of jobs. So you don't have when I came into the industry in 2005. there were a number of projects that you knew about that can be turned up in a 10 to 12 year time frame. Now that bench of greenfield projects just isn't as deep as it was, and it's also taking longer to turn these projects up. So, if you go back 10 or 15 years, it probably took something on the order of 12 to 15 years to turn up a project. I had a conversation with a management team, has a very attractive asset in British Columbia, fairly close to ports and waterways and roads. And this guy's been at it 24 years, and it seems like it's going to be at least another 10 years before it turns up. So 34 years to turn up a mine. Um, as you can see, we're talking about needing double the production in 2040 and another 25% or so by 2050 to turn up that amount of capacity, given the timeframes it takes to even just turn up a very straightforward mine. You start to scratch your head and wonder, how this is going to all come together outside of pricing going substantially higher, which when prices go higher, people figure it out. But, in the current market environment that we're in with, copper price of 425, there doesn't seem to be any urgency to really get after these projects.
Yeah, without prices going up, it's hard to bring new mines online. You've already mentioned this, but what is about like old mines? Is there any magic that can be done if prices go up? Like exploit more, get more resources online?
I think, and let me just make sure I understood your question. You're asking what impact higher prices would have on the acceleration of development.
In existing mines, so if you already have the permission to drill and dig for copper, is there any magic that can be done with these mines if prices go up?
Yeah, that's part of it. I think that on the brownfield developments, if you will, that will certainly give companies an incentive to make investments in near mine production. But that's fairly limited in and of itself, right? Because as you think about a mine, and again, just using an open pit mine as an example, um,
Maybe you can explain open pit a bit, then people can get an idea what open pit means.
so those are the open cuts in the earth that you can sometimes see when you're flying. If you're in the air, it's just a big hole in the ground that you have the Caterpillar trucks or the Komatsu trucks that are taking the earth from one point in the ground to the processing facility somewhere else. But these open pit mines, um, when you lay out your design, you're laying out your design for 25 or 30 years. And then once the ore grades or once the ore has been exhausted, that's it. You reclaim it. You sometimes fill the pit back in. You put in vegetation into place, what have you. Now, if prices go high and you say, "Oh, I want to build out further. I want to make this pit bigger. I want to make it deeper," there's consequences around that. Um, it's easy to say, but when you're moving um, billions of pounds or billions of tons of dirt, it takes a lot of planning and logistics to make that happen. And so, I mean, there are ways that mining companies can increase production 5 to 10% from existing operations, installing equipment, gaining efficiencies, um, incremental improvements. But oftentimes, those alone are offset by the decreasing ore grade that you experience every year when you're operating a mine.
Yeah, if you think about copper like harvesting, are the low hanging fruits in the copper space already picked, or is there a lot of like low hanging fruits globally out there that can be harvested in the copper space?
So that's the challenge. I would say the low hanging fruit has been harvested. I think that the true low hanging fruit was in Chile in the 50s and 60s. Even before that, they were mining copper in Chile. Um, you had problems politically in Chile in the 70s, pushed some exploration to Peru. And there's obviously tremendous amount going on in the US and Canada as well. But now, if you're looking for those next large deposits, you're having to go to far flung places. Um, a major gold company announced about 3 months ago, I believe, that they were going to Pakistan for a copper mine it's been known about for a long time, but just given the political uncertainty of operating in Pakistan, no one was willing to go after that deposit. I think that there's some deposits in Afghanistan as well. I think there's some deposits in Iran, but again, you need a higher copper price to offset the risk that you're taking on. Um, if you invest $1 in Arizona or Nevada in the United States, you have a certain return profile that a mining company would expect. If they're going to invest $1 in Pakistan or in some regions of Africa, you need a higher return on that investment to justify that. So I guess the short answer is the low hanging fruit has been found from a political stability perspective. There may be other low hanging fruit out there, but it's going to be in much riskier places than where mining companies have been comfortable operating historically.
In our pre-talks, we chatted about ore grades and like what this means for the production of mines. So you said that like the ore grade was at 1 or above 1 a few decades ago, and now it's 0.5, 0.7 for many mines, and that's seen as a good ore grade. What does this mean for copper production?
Yeah, when you're operating a mine and when you build a mine, you're trying to generate the highest possible return that you can. So that means you harvest or you mine the highest ore grade first, and then and that gives you the highest cash flow in your earliest years of your mine, and then over time you harvest the rest. Obviously, you're constantly going after the highest ore grade, uh, but just using round numbers, um, if your ore grade is in your first day is at 1% and your ore grade at year 15 is 0.5%, um, you've effectively, it's probably about twice as expensive to operate that mine in year 15 as it was in year one, because the operation of a mine, the ore grade is the most important metric that there is. Obviously, you have infrastructure considerations to get to that ore grade. So, if you have just there's no deposits that I'm aware of in Antarctica, but if you had a copper mine that had a 2% ore grade in Antarctica, and then you had a copper deposit that had a 0.5% ore grade in Arizona, it may be cheaper in Arizona because of the infrastructure that's necessary. But if they're right next to each other, you would always go with the highest ore grade first. Um, I think that just on a global basis, companies being return seeking, all of the mining companies have been going after the highest ore grades. It's not something new in the industry, if you will. I think it's just the way that mining companies operate. But given that fact, globally, you've seen ore grades steadily decline over the last 20 years, and I think that they will continue to decline um, for as long as people are requiring these minerals for consumption.
So there's no magic reserve where some have kept the highest grade to eat them latest? Maybe?
No, no. So I think that um, there's a number of folks out there that follow the mining industry, and if a company is producing at below their average ore grade, management teams get questions, and I think that's a very easy way for a management team to draw in activists and possibly lose their jobs if they aren't generating the highest and best returns as quickly as possible. So I don't think that there's sort of any um, deposit out there that is going to dramatically shift the direction of the copper markets globally. Certainly not for a sustained period of time. I think that you've had these deposits that have come on that Grasberg, for example, in the 90s, maybe Oyu Tolgoi more recently, that they shift the global ore grade a little bit higher for a very short period of time, but then it resumes its fall as it has, um, for many many years.
Like, how rational is the industry? Like, if you talk about the mining industry and commodities, you hear crazy stories about wild deals on the top of the cycle for high multiples and stuff like this. Has this changed? Has the industry become more rational with the younger generation?
I think that it's gotten better. Um, there still are companies, and I, there are companies that do questionable deals all the time, and I think in every industry. And I think that given the risks that you take on with mining, on some level, it's worse because of the cyclicality of the business. But the mining companies have gotten better over the last 10 years, and it's very similar to what you're seeing in the oil and gas side of things, right? The oil and gas companies are beginning to get complaints about why aren't they exploring for more oil and gas, and just instead they're paying dividends and buying back shares. Um, on some level, buying dividend or paying dividends and buying back shares is much easier to understand for investors than to say, hey, I'm going to this far flung area, whether it be Greenland or Africa or the middle of Australia, and I'm going to spend $5 billion and hopefully I can generate a return. Um, that's not viewed as favorably as it was in the past. Now investors are much more focused on, hey, let's get the cash flow back to us, and we'll make the decisions on whether we want to be in a exploration company or a producing company.
Could it be that we are wrong and, like, for copper, a lot of the supply shortage is already priced in, and like that our arguments here are wrong? Or what is the counter arguments to the arguments we are making here, or you're making here?
I think that there is. I think that you had a tweet from Elon Musk uh, last week that was saying the world doesn't require any more copper. He's more focused on lithium, um, and it just depends on how you view the energy transition. If you view 2050 as being sacrosanct, then we need a lot more copper than what we are currently producing. If you think the energy transition is going to last until 2100, 2150, there's still going to be a lot of demand, but it's just going to come in a further out period. There may be other offsetting technologies that we're just not aware of. So I think a portion of it really comes down to how quickly this energy transition will happen. Um, and that's something that I think no one is completely certain on. I think that the 2050 number is it's a good target, right? And I think that um, using that target, you come to the conclusions that I've come to on the demand that will be there for copper. If that gets dragged out, and it have to get dragged out a substantial amount of time, right? If it's going to happen in 2060, 2070, those, while sounding very far away, in the mining industry, when you're talking about developing new deposits, it's like I said, uh, I've been talking to a guy that has been at it for 24 years, and he probably thinks that he has 10, which may bleed to be into 15 to 20 more years for his deposit to develop. But again, if the energy transition bleeds out into 2100 in that sort of scenario, um, maybe the requirements won't be as large as I'm currently thinking about.
When thinking about the energy transition or like the units of the energy transition, like solar plants or wind turbines, what kind of share of the price of them does copper make? So if the copper price doubles and quadruples and whatever goes to the moon, could the increase in the copper price also be a hurdle for the energy transition?
So that's a good question. I think that um, the U.S. government puts out solar data on a monthly basis, and you've seen the cost of production for a solar cell steadily decrease. Since since the as far as the data goes back, 1991, 1992, something of that nature. Um, but we've started to see that flatten out in just the last 6 months or so. I think a portion of that is more just related to inflation, um, broadly speaking, and then some backup in the polysilica that we're getting from China. And this is just on the solar side of things. But I think that copper prices would probably need to go 50 to 60% higher before they would start to impact the overall solar equation, if you will, because we've already seen prices go from $2 to $4 from 2006 to 2023, and that really hasn't impacted the the steady price declines in solar cells. Maybe if prices went, like I said, 50 or 60% higher from here, that would start to impact the prices. Um, but it's, you know, the solar systems, there's so many different parts and there's so many different engineers focused on it until, on the cell side of things, they keep on making improvements. Um, Maybe it won't have as large an impact as I'm thinking.
So, what role in the equation does China play? Like, if you think about the history of the copper growth in demand, a lot of it came from China, and I think they're still demanding a lot of copper. So, if you think about the demographic shift in China and like maybe their expansion in housing and stuff like this, could this also be a thesis breaker, this kind of change in demand in China?
Yeah, copper is, or excuse me, China is the largest consumer of copper, and probably since about 2013, they've consumed 50% or larger of the world's um, copper consumption. I think that the Chinese housing market's definitely a concern. Um, the rollover in the Chinese population, I think, is something we have to constantly think about. Um, so, the unfortunate thing about China is it's a bit of a black box relative to some of the other countries where data is very transparent, and you have a pretty good understanding on end markets and um, also on the supply side of things where things are coming from. um, you just see the copper concentrate go into China, and you have a pretty good understanding that a lot of it is going into that residential market. But then also, you have the fact that China is one of the most aggressive countries on the electric vehicle side of things. So it's a bit of a black box, and there's always concerns when you're talking about Chinese demand, just given the size of that country and everyone's demand models. But I think there are puts and takes on um, how that may ultimately play out.
I'm really not the typical investor into metals and mining, and I'm coming to the space with a curiosity and an outside view, and more an interest in energy transition, what this means. And if I observe when I observe the industry, it feels a bit like it's Wild West, especially the exploration space, where you need a lot of retail to finance interesting projects somewhere in the mountains in Chile or something like this. And you have also these conferences that, yeah, have interesting characters there on the speaker panels, and it feels a bit like, sometimes a bit like fraudstery, this industry. And I don't want to accuse anything of anyone of anything, but it's like a bit of a Wild West place. So it boils down to a question: what is your way of playing copper intelligently? What are ways where you avoid the dark sides of the industry, so to say?
Yeah, what I would say is, um, for investors that are interested in basic materials, um, you want to start off very simply and right down the middle of the fairway, if you will. And there's and I don't have positions in any of these names, but you think about the big guys first: your BHP, your Rio Tinto, your Vale, Glencore, Freeport. Those are commodity producing companies. On some level, they're almost like commodity ETFs because they'll move around with the price of the underlying commodities that they produce. Um, and once you're comfortable and understand those names, if you're looking for smaller names, you sort of, my recommendation would be that companies that have producing mines, there's probably 25 to 30 companies out there that they produce, has one or two producing mines. That if you like copper, you can buy this as a copper name. If you like zinc, you can buy this as a zinc name. If you like iron ore, you can buy that as an iron ore name. Typically, you get into less dodgy situations in companies that have producing assets than companies that are really your exploration and development companies. And I think if you've talked to management teams and you've gone through um, feasibility studies, which are the studies that these companies put out regarding assets, and you want to get more involved in some of the smaller cap exploration and development plays, um, those names are out there for you as well. But again, as you say, that is where things are a little bit more of the Wild West than the larger cap names.
Where do you feel comfortable to invest with your fund?
So I'm typically looking at those names that have one or two producing assets, um, and typically just produce one or two commodities. As you produce copper from a copper deposit, you also get gold and silver. Sometimes you get molybdenum as well. But really, just focusing on companies that produce. Um, you know, I'm not looking for a big diversified mining company. I'm really looking at companies that um, run deposits well. Maybe have a development company that, or excuse me, a development deposit that they're working on that may come into production at some point over the next 5 to 7 years, as sort of their growth to that story. But really, just looking at companies that are extremely focused on producing cash flows from an existing deposit. So I'm not even really looking at companies that are in the process of building out new production. Really, just looking for producers that stand to benefit from the upcycle that we see in the basic materials.
Are there any hacks to find good investment in this space? Like you always have to do hard work and your own due diligence, but like, is there anything to invest in a certain management team or a certain firm that has a good track record to do this, or to invest around the corner, like into a certain holding that's super interesting? Is there anything that comes to mind for you?
Yeah, I think you have a good point on the management teams. I think management teams and cash flows are two of the most important things. A company's ability to generate cash flow through the cycle. So we've had some extremely challenging years in 2008 through 2010, maybe 2008, 2009, really 2015, 2016 were some challenging times in the mining space. If they're able to generate cash flow through those points in time, you have a pretty good feeling that they're not going to run out of capital or have a some sort of crunch on their balance sheet. The first thing I would look for. The second thing is, again, the management team, like you said. So if a management team has performed well in this company, particularly if they've performed well in a previous company, maybe they sold that company, and this is their new thing that they're working on. Those are typically pretty good management teams to follow. Um, I mean, that would be where I would start. And then also, you really want to be careful on where the deposit is located. So, I mean, there's not really any deposits in Venezuela anymore, for example. I mean, there were a couple of deposits in Venezuela when I started in the industry, and the government took those away from the companies that were operating those or developing those projects. You want to be careful in the jurisdictions that you go into. So, you know, most of the companies are operating and most of the public companies are operating in fairly benign jurisdictions, but certainly there are places in Africa which, um, you know, there's places in, I mean, even Chile tried to change their constitution to increase the taxes and royalties that they were going to charge mining companies. But so you historically think of Chile as being a very safe.
Yeah, I've also heard about a Polish copper company that is, if it's really profitable, the Polish state gets interested into taking away some of the profits with taxes. I'm not haven't studied this case myself, but a friend who's an investor told me about this.
Yeah, no, that's right. That's right. That story's out there for sure. I mean, that's the challenge of mining, right? When prices are high, governments want more taxes. Typically, when prices are low, is when you're in a recession, and the governments also want you to increase your employment, despite the fact that makes your cost of operations higher if you have more employees. So you get squeezed on both sides. It's a challenge. I think that the mining industry will has had and will continue to have, particularly if prices go up in the fashion that we think they will.
So, how do you think about energy input in the ratio to get out a certain product? So, if you think about, for instance, open pit mine, you need a lot of energy to get out product. You have to crush a lot of stones to get the copper out. So, how do you think about this ratio of energy input and output of product in your analysis?
Yeah, I mean, the cost of diesel is a significant input in the mining equation. The good thing is, a lot of mining companies are electrifying in their own right. So, you know, they the battery technology isn't really there yet to move one of these big trucks around. But what they can do is they can have overhead wiring that's very similar to what you would see in cable cars in some places in the world. and the trucks will attach on to those cables and then be electrified to get pulled into the mill typically. Um, but you can't do that all the way, just given the way that the mine is constantly changing in that open pit configuration. But that being said, most mines are use a tremendous amount of diesel and high energy prices, and we've seen this despite the fact that prices are high for commodities right now. Some companies in the last quarter, just given the inputs, um, explosives, employees, the diesel, the electricity to operate the mine, the steel balls that they use for crushing. Um, Margins were very thin for some of these companies in the fourth quarter of last year. So, um, I can't really think of a situation where high diesel prices has put a company out of business, if you will, but certainly it could create pressure on margins for them.
And another topic we have discussed in our pre-talks, but I don't want to touch into too much depth in this interview, is uranium. Maybe you want to use the chance to add something on your use in this space?
Yeah, absolutely. I think that uranium and the nuclear build out that's going to occur, probably more so internationally than in the United States. Um, the uranium and nuclear power has long been viewed as the cleanest baseload power that's out there. Obviously, always on, but I think that as we go through the next 10 years here, you see a tremendous build out in places like China, even places in the Middle East where power is or not power, but energy is fairly cheap. They're turning to nuclear, just given the fact that you know these nuclear assets once they're built, they're 50, 60, 70-year assets that you sort of know how much it's going to cost for you to produce power, even in a higher uranium price environment. So it gives you some stability, I think, to your grid. That again, I think most countries are investing very aggressively in wind and solar, but having that stable baseload of nuclear power um, provides you a lot of flexibility that is hard to come by without going towards those fossil fuels.
Another topic we haven't discussed, but we discussed in our pre-talks, is the topic of nearshoring and reshoring. So a lot of, like, we have these economic tensions, we have real war in the world, or in Europe again. So a lot of industries try to reshore and nearshore. What does this mean, especially for businesses we might consider as boring and commodity, like in your eyes?
Yeah, I mean, I think that the reshoring and nearshoring um, is going to create a tremendous demand for um, steel in particular. Um, there are other commodities that it will be important for as well, but steel in particular, on some level, maybe aluminum. But as you think about the U.S. and Europe and Japan building out capabilities and capacities in all sorts of all sorts of semiconductors and medical applications. One, it's inflationary, but two, to have all these redundancies across the globe is going to create a tremendous demand for the infrastructure that's required to have this productive capability. So, as you think about the world right now, obviously a lot of stuff is built in emerging markets, particularly in China, Southeast Asia, what have you. Um,
Yeah, like half of my room here.
exactly, exactly. Um, but now you're going to have that capability in possibly three, four, maybe five different regions of the world. Um, it's going to make the world more commodity intensive than it has been in the past. Again, that will be inflationary in its own right, but it's good for the demand side of things of basic materials.
For the end of our interview, I always give my guests a chance to add something. So, is there anything you want to add, especially on the renewables and energy transition side? Is there anything?
I mean, I think that it's an exciting time for basic materials. I think that basic materials have gotten a bad reputation, just given some of the deals that have happened in the past that have destroyed shareholder value. It's really scared a whole class of folks away from the industry for the better part of 10 years. And then not just the investor class, but also, folks who may be interested in working in the industry. I think that, going to work in a zinc mine in a far flung place or going to work in a lithium mine was really not viewed. It was sort of viewed as a dead end career, if you will. But I think that the industry is coming back in many ways that will make it very important, not only as investments, but having careers beyond. I think Wall Street or finance, certainly over the next 30 to 40 years.
Yeah, that's another very interesting aspect. I think there's a lack of talent in this space, and also the working conditions are hard.
Yeah, I mean, there was one study that was put out that said the average mine worker is 55, so 55, and you can obviously imagine them retiring at somewhere around 60, 62, and that's the average. There's probably a lot of guys that are out there that are 65 and 70 and just love what they do and have kept on doing it, but really a dearth of talent. Many colleges don't offer mining engineering programs. Obviously, I think a lot of colleges have cut back on even geology programs, if you will. And I think that it's had somewhat of a bad connotation because you think about geology and a lot of those folks go into the oil and gas industry or historically have. So I think there have been cutbacks in that area, just given people's focus on a energy transition or having greener sources of power. But you've also really cut away the pipeline for folks in the mining industry as well. So yeah, I think there'll be a lot of opportunity there.
Thank you very much for your insights, and thank you very much for answering all my questions. I think this is a lot of food for thought for the listeners that stayed till here. So thank
Thanks
you
for having
for
me.
staying till here, and bye bye.